All right, Ajay, you made a couple of points, so let's take that forward. Then you spoke about earnings, so we're going to be taking note of earnings as well as IT. Reema is going across to the big ball to, give us a complete wrap of what we saw this week. Reema.
Well, the last 3 days were all about IT, so I thought it would be nice to just give a complete snapshot of what the IT earnings were in 10 quick charts. Right? So the first one is Q2 revenues. Now, Q2 revenues were largely muted, a continuation of the weak demand over the last 2 quarters. There is no big deterioration, but there isn't big improvement. In fact, TCS and HCL Tech both disappointed the street on the top line. The second one is on margins. Now, all the 3 IT companies, TCS, Infosys, HCL Tech, positively surprised the street on the margin front. Now, this was led by better employee pyramid. It was led by better utilization, a headcount reduction, perhaps some cut in discretionary spending. Infosys has embarked on a Project Maximus, a cost optimization plan. So the margin performance in Q2 looked very good. But the key highlight, and that's the third plate, are the deal wins. Record high deal wins coming in from Infosys, HCL Tech. For TCS, it's the second highest on record. And just compare the current quarter's deal wins versus the average over the last 12 quarters. The only thing is that these deals are largely long tenure in nature. Yet, the IT index closed with a cut of 1.5% to 2%, and that's because the outlook for this year continues to be very weak. IT companies are likely to grow in low single digits. Infosys lowered its revenue guidance for the second consecutive quarter. They started the year saying that we're going to grow at 4 to 7%. Then they brought it down to 1 to 3.5%. And this quarter, they further lowered the top end of the guidance, and now it stands at 1 to 2.5%. HCL Tech too started the year saying that we're going to grow at 6 to 8%, but now they're saying, well, including the acquisition that we've done, we're going to grow at 5 to 6%. The margin guidance for FY24 has been maintained, both by Infi and HCL Tech. One of the other notable trends we've been seeing is the sharp reduction in the headcount. Demand is moderated, and so is the employee requirement. And plus, over the last 2 years, companies did overhire compared to the demand requirement right now. This is the headcount reduction seen in the current quarter. Attrition, too, has fallen off, and fallen off quite sharply. In fact, attrition now for all these companies is back to what it was on a pre-COVID levels. So if you remember, over the last 2 or 3 quarters, attrition levels had crossed 20%. Now it's back to that 14-15% band for the IT companies. So sharp drop-off from the peak levels. Now, what's the sum and substance of all this, right? What is the analyst community made of it? Well, they've lowered the growth forecast because of the miss in Q1 and Q2 and the fact that growth expectations have pushed forward. Yet again, the street was hoping that in H2 we will see a pickup in growth, but that's not really materialized from the body language of Infosys and TCS. So right now, the street has lowered the full year growth forecast. What they've done, they're now saying is that in FY25, we are going to see a big pickup in growth. So growth rebound will take place only in FY25, not in FY24. And finally, let me bring you how the stocks have performed. In the last 3 months, the stocks have outperformed. In fact, on an average, the Nifty IT index is up 7% in the last 3 months versus the Nifty which is up 1.5%. Now, this was driven by 2 factors, the strong deal wins that we've seen in the last 3 months and 2 expectations of a growth pickup. Now, that growth recovery expectation has been pushed forward by at least 2 quarters. Growth recovery is likely to take place only in FY25. So now the big question is that as growth visibility is quite muted for the next 2 quarters, is it time to bet on the IT sector? Ajay, where do you